Big macro events like CPI prints, Fed announcements, and Jobs Friday can move markets in seconds. For options traders, these days are loaded with opportunity and risk. In this video, we'll break down how to build an event-driven options game plan so you can trade smarter when the market is on edge. Why events matter. Events like CPI, FOMC, and Jobs Day are catalysts. CPI reveals inflation trends, a big driver of rates and equity moves. FOMC meetings set monetary policy. One word from the Fed can swing the market. Jobs data signals economic health, often sparking volatility in bonds, the dollar, and equities. Markets hate uncertainty. These events remove it, which is why implied volatility spikes before the release and then collapses after. The market's setup. Before each event, look at what the options market is pricing in. Check the implied move, usually visible in at-the-money straddles. Compare it to historical reactions. If CPI usually moves the S&P 1%, but options are pricing a 2% move, premium sellers may see an edge. If the opposite is true, buyers might have the advantage. Understanding what's already priced in is the foundation of your game plan. Strategy Playbook. Now, let's build the toolbox. Volatility sellers, straddles, strangles, iron condors. Best when implied move is larger than history suggests. Risk. One shock headline can blow through your strikes. Volatility buyers. Long calls, puts, or debit spreads. Best when options look cheap compared to past event moves. Risk. If the event underwhelms, IV crush can kill the trade. Directional bias trades. Broken wing butterflies, calendars, diagonals. Useful if you expect a one-sided surprise. Hawkish Fed, hot CPI, weak jobs. Risk. You need both direction and magnitude to align. The right structure depends on whether you're playing the event risk or the post-event drift. Risk management rules. Event-driven trades are high risk, so discipline is key. Size small. Treat them like speculative plays. Use defined risk structures, debit spreads or butterflies instead of naked straddles. Time the exit. Sometimes the best play is entering before the event and exiting right after IV spikes, without holding through the announcement. Remember, you're not just betting on the data, you're betting on how the market reacts to the data compared to expectations. To recap, CPI, FOMC, and Jobs Day are major catalysts that drive volatility. Always check the implied move versus historical reactions to frame your edge. Choose the right play. Selling volume if options are overpriced, buying volume if underpriced, or structured directional trades if you have conviction. Manage risk ruthlessly. These events can surprise even the best traders. With the right game plan, you can approach event days with strategy, not guesswork. If you enjoyed this breakdown, hit like, subscribe for more trading strategies, and comment below. Which event do you find hardest to trade? CPI, FOMC, or Jobs Day?